It's a pleasure to have this session of the London Financial Regulation Seminar today with Professor Holger Spamann of Harvard Law School and our own Daniele D'Alvia as the discussant. Just a couple of words for everyone. This is our second session of the London Financial Regulation Seminar this academic year. It is an intercollegiate and interdisciplinary group of experts in financial regulation, which is led by myself and Professor Rosa Lastra and Dr. Daniele D'Alvia. And today we have both very interesting subject and a very interesting main speaker. The subject is indirect investor protection, the investment ecosystem, and its legal underpinnings. A relatively broad title, which actually fits very nicely for many of our students that are starting the academic year and are trying to figure out the ecosystem in banking and finance. And it's been published in the Journal of Legal Analysis, Volume 14, Issue 1, 2022. If someone wants to read the paper after the session, maybe some of you have already read it. Professor Holger Spamann is the Lawrence Grove Professor of Law at Harvard Law School, where he teaches corporate law and corporate finance. And he has his research focuses, like myself, on law and economics, but the law and economics of corporate governance and financial markets, judicial behavior, and comparative law. He also was in private practice with Debevoise Plimpton before joining academia, and he also clerked for 2 years in Europe. So really all-encompassing, as I like it to be. He's interdisciplinary, multidisciplinary, and also interjurisdictional, because he has his education spans from London School of Economics, Hamburg, Harvard, and also law and economics, which is wonderful. And what he's going to present today, obviously I'm going to let him soon explain himself what he's doing, but we announce it in the website of the London Financial Regulation Seminar, how this research article argues that the key mechanism protecting portfolio investors in public corporate securities are indirect, that they do not rely on actions by the investors or by any private actor charged with looking after investors' interest. Rather, they're provided by this ecosystem that investors are actually legally forced to inhabit, or sometimes also the byproduct of the self-interested, mutually and legally constrained behavior of third parties without a mandate to help the investors, such as speculators, activists, and plaintiff lawyers. On speculators, I have to say that, and I will introduce Dr. Daniele D'Alvia after. He himself has written a lot about the speculation and risk. So I'm extremely happy. Part of the networking and the ecosystem in academia is also to develop network of scholars. And I'm delighted today, not only that you're presenting, but that you have also teamed up with Daniele D'Alvia, whose interest, some of his interest and yours also, there is an intersection in the way that you approach the themes. So thank you very much for being with us. I will mute myself and give the floor to you.
Okay, well, thank you very much for the kind introduction. I'm very glad to be here, very glad to talk about this topic of indirect investor protection, the investment ecosystem, and its legal underpinnings. As Rosa said, the paper is published, but I care very much about this idea. I think it says something very important, at least about the United States. So presenting it in an English forum is actually quite exciting, because I want to see how far this idea carries, whether it is able to explain also what is going on in the UK, or to what extent it maybe is not able to explain this. And so hopefully the discussion with you and with Daniele will bring this out. Before I launch into the details, I should maybe say what I mean here by investor protection. When I talk about investor protection, I mean the big stuff. What's the big stuff? The big stuff, at least in the United States, is retirement saving. That's the big stuff. Here we're talking tens of trillions of dollars that are being invested all the time on behalf of retirement savers like myself. And when I say on my behalf, that is partially through pension plan administrators, but practically speaking, nowadays, mostly it is self-administered pension savings. So I have a 401k plan, as it's called in the United States, like all of my colleagues do. And virtually now everybody who saves for retirement in the United States, except government employees, has this, where I myself choose where to allocate my money, which is usually some sort of mutual fund. I don't know what you call it in the United Kingdom. I used to know this. It's a collective investment vehicle where especially index funds are organized like this, which is how I invest my money. And the question is, when I do that, why can I be confident, and I am confident, that I will not only get my money back, but I will actually earn a sizable return? And again, we're talking about tens of trillions of dollars. And I can assure you, even though I'm a scholar of finance and of law, I spend approximately zero time looking at my investments. So how is it possible that I will get something back in return? That's just for setting the stage. And I think you can see parallels in the United Kingdom. Okay, the argument in a nutshell is as follows. Here's the puzzle. Why does the dumb money do so well investing in public corporate securities? Dumb money, of course, includes people like myself. There's tens of trillions of US dollars invested, and they have been earning a 5% geometric return for decades on average. Why don't the investors squander their money on bad investments? Why don't portfolio companies mismanage and self-deal so that the money would basically disappear? The standard answer is what I call direct investor protection. I will sometimes abbreviate this as DIP. And that answer is that investors have corporate disclosures and governance rights to vote, to sue, and to sell, with which they can somehow make sure that they will get their money back. But here's the problem. The dumb money lacks the expertise, the incentive, and/or the interest to actually read those disclosures and exercise those rights. So how could this possibly work? My answer is it doesn't work. We have something else, which I call indirect investor protection, which I will sometimes abbreviate as IIP on these slides. How does it work? In public markets, most investors don't need rights and disclosures because others create the conditions without intending to, without a mandate, and without compensation. Who are these others? I will talk about all of this in much more detail. There are speculators that create fair prices, which is something I have to put in scare quotes because fair price, what does that mean? There are plaintiff lawyers who stop self-dealing. And there are activist shareholders and takeover companies that stop mismanagement either by directly interfering or by offering to buy out the company at a higher price. I should maybe say at this point that the one actor on the slide that I think the UK does not have is the plaintiff lawyer. And that's the concept that's hard to explain to non-Americans. That is basically a law firm that has a pro forma client, but the client is just pro forma. Really what's happening is that the law firm is bringing a lawsuit on behalf of a class or on behalf of all the investors in the company. And in the end will be compensated with some percentage reward of the recovery that they earn for the class. And I can say more about that later if that's desired. Okay, so that's my answer in a nutshell. And basically, I will just spend more time explaining this in some detail. Why am I doing this? There is a normative payoff. A normative payoff, I think, is to understand which rules are important and why. Indirect investor protection needs an interest alignment, rewards, and channeling, which is quite different from what you would want if you believed in direct investor protection. And I'll explain what I mean by those things. There's another very important normative payoff, which is why do we have any mandatory rules at all? And I'll explain in a bit why that is an important question and one that so far I don't think got a good answer. And my answer is we only need those mandatory rules that align smart and dumb money with respect to the price plus some redundancy. And then I will have an outlook if we have time. What does the growth of passive investment, index funds, bring for the world of investment? It undermines trading-based indirect investor protection rewards. And so maybe we have to institute a novel system to reward those activities. Anyway, that's all a lot now and probably more than you can quickly understand. So let's get into the argument and explain all of this in a little bit more detail. I should say first, why do I care about investor returns at all? Or why should we care about investor returns at all? We're not here in an investment funds investment committee. We're not deciding where we want to put our money because we want to make as much money as possible. We here in an academic seminar, and usually in an academic seminar talking about normative questions, there has to be a normative criterion. Why do we care about this at all? And there's two answers. One is we care for the sake of investors. We like that people are able to save for retirement. But we also care, number two, for everyone's sake, because we need firm financing and we probably need good governance for those firms. Subpoint one, if investors don't expect a good return, they won't invest. So investor protection is necessary in order to get people to invest in companies in the first place. Subpoint number two, returns reflect governance, meaning the inefficient use of existing resources will depress returns. Low returns indicate inefficient use of existing resources. Why could the resources be inefficiently used? Well, they might be stealing by managers and controlling stockholders, which distracts them from the business. The stealing itself is redistribution. It doesn't matter on a global welfare perspective, but the distraction is very, very important, and that is something we want to curb. And of course, there's slack and mismanagement, or the risk of slack and mismanagement, and we want to curb that. Protecting investors tends to stop both of these subpoints, and which is why through the back door, through investor protection, we get these good things also. All right. Secondly, what do I mean by dumb money? I already included myself in this, and it's not that I have that low of self-confidence. But what I mean by this is that retail investors, such as myself, who direct their own investment, just simply don't have the abilities. Maybe I would, I don't know, but I certainly don't have the time, and I certainly don't have the interest to actually look carefully at what happens with my money. It's also a huge collective action problem, obviously. There are retail investors' funds who have fund managers. So in principle, they might do the job, but the incentives for these fund managers are extremely poor because they get basically nothing of any value that they create for their investors. And in fact, they get penalized to the extent that they spend money and thereby drive up their own cost, when the investments that they monitor are exactly the same investments as their competitors also have in their portfolio. And so therefore, the incentives are simply not to monitor. There are many pension funds and endowments, which I would also include in the dumb money. I'm sure that there are some that are well managed and that look very carefully at what's happening with their money, but others we know from experience and from reflection are not so good at doing it. Even the very smartest investors in the world, some hedge funds, are dumb money sometimes, in the sense that sometimes they have some money left over, some dry powder. What do they do with it? They stack it away somewhere where they don't have to spend any energy monitoring it. And while they do that, when they put their excess money in some index fund, they are also dumb money in my terminology, because they are not actually spending time and effort to monitor what's happening with this money. So most investor money is dumb money in my terminology. Now, let's get to the impossibility of direct investor protection. Why can direct investor protection not possibly explain why all of this dumb money is faring relatively well in the public markets? Retail investors are obviously useless. That's clear. Mutual funds, I already just said this, I should have perhaps waited until this slide, that the incentives are poor or perverse, and their track record, in fact, is abysmal. Again, I'm not speaking for the UK here. You tell me what's happening in the UK. In the United States, the largest funds such as BlackRock, Vanguard, Fidelity, State Street, they never sue. They vote mostly because the SEC forces them to, and they are also now trying to divulge that and let their end investors exercise their voting rights. They never bring shareholder proposals. Index funds don't perform portfolio selection. They never sell. They don't do anything. So they cannot be the driving force why things work out well. Pension funds, endowments are already mentioned. Smart money are already mentioned. So again, most of it doesn't work. Let's therefore talk about the vectors of indirect investor protection. What else is stepping in the breach when the dumb money doesn't read the disclosures, doesn't sue, doesn't make any proposals, barely votes? What else steps in? Well, there are speculators that create approximately unbiased informative market prices. Note that nothing on this slide says efficient markets. I'm not going to get into this religious debate. All that I mean here by approximately unbiased informative market prices are prices that obviate the need for valuing investments. You can put your money, as Burton Malkiel said, you can blindfold yourself and throw darts at the Wall Street Journal stock pages, and you will not incur trading losses or gains for that matter. You will get a fair price. You will do approximately as well as all the other traders in the market. That's super important, and it would not be true in a private market. It's important not only because you don't lose if you do that as a dumb investor. It's also important because to the extent that the prices are approximately unbiased and informative, well-governed firms and well-conceived governance structures will fetch a higher price, creating an incentives for those who create companies to have good governance structures in place. You can also use these prices for executive compensation to reward activists who may buy an underpriced stock, or I shouldn't say underpriced, who may buy a mismanaged company, agitate to turn the company around, and because the prices reflect the improvement in the company, then sell for a larger amount of money, thus making a profit, thus making their activity privately rewarding for the activists. That's why they do it. In the process, they help everybody else who also is invested in this company and therefore is making a profit. I already mentioned that I don't need perfect market efficiency. Let me skip that. Now, let me talk briefly about the plaintiff lawyers. What do the plaintiff lawyers do for us? I already said who they are. They are law firms who basically prosecute lawsuits by themselves. To give you a sense, maybe you've heard that Elon Musk's executive compensation package at Tesla was rescinded by a Delaware court earlier this year. That was a plaintiff lawyer bringing that lawsuit, challenging Musk's compensation basically as self-dealing and presumptively unfair, and Musk did not bear his burden of proving that it was fair, so therefore the compensation was rescinded. Now, whether you think that in this particular case the compensation should have been rescinded or not is really neither here nor there, but in principle, imagine somebody like Musk, who may or may not be a controlling stockholder, who certainly has a lot of influence over the company, awarding himself a multi-billion-dollar compensation package. If that were not policed by anybody, you can see how the money would just flow out of the companies, and investors like me, we would be left with, I mean, maybe not nothing, but certainly much less than we were hoping to get. So you need somebody who stops this. Who's this? Plaintiff lawyers. The plaintiff lawyers, as I said, they have a figurehead client, but they are really doing it for themselves, and they're not being paid by me. They're not being paid by anybody. They're not being mandated by investors at large to do this. They do it out of their own self-interest because they get a fee award at the end. And nonetheless, they help me and all the other investors in the company when they do whatever they're doing. We have activists and takeover buyers. Why are they important? Well, they deter and fix mismanagement. How? If the company is poorly managed, an activist will sweep in, or a takeover offer will appear that will either fix up the company or buy it out. And when takeover buyers buy out companies, they usually offer a premium. They compete against one another. So ultimately, they will buy the company to something that approaches its value under good management, and thereby all the other investors who are selling in the company will actually get the full potential value of the company, not the depressed value that they would get if the mismanagement continued. The really critical point here is that all of these activities, speculators, plaintiff lawyers, and activities, are not hired or chosen by the dumb money. They're not paid by the dumb money, and they have no mandate to help the dumb money, and they're not motivated to help the dumb money. But they are constrained by rules and competition to basically do only things that benefit investors at large. This cannot be stressed enough. I am making absolutely no claim here that speculators, plaintiff lawyers, or shareholder activists are in any way good people. I'm not saying that they're bad people either. It doesn't matter. The only thing that matters is that their activities actually help investors at large. It's like bacteria. I think it's foolish to say that bacteria are good or bad, or even that they're like have good intentions or bad intentions. They have no intentions. They can be good in the right place and they can be really bad in the wrong place. Likewise, speculators, plaintiff lawyers, activists, takeover buyers, they could be really bad if they were not properly guardrailed, but they will do good if they are channeled into the right activities that actually help investors at large. So if you doubt how important, if you're asking yourself, well, how do I believe this story? How important could this indirect investor protection possibly be? Could it really be more important than what we usually associate with investor protection in public markets? I encourage you to conduct the following thought experiment. Imagine two variations of today's world. On the left, DIP only direct investor protection, meaning you remove the indirect investor protection so that the public market becomes more or less like a private market. That means there are no market prices, there are no takeovers, or at least no hostile takeovers, there are no plaintiff lawyers, and there are no activists. That's one world. And now imagine you, for example, saving for retirement. Would you want to put that money into that market? I'll tell you my answer, hell no, I would not want to do that because, first of all, I would probably way overpay for whatever I'm buying because I have no clue. There is no market price that ensures that I'm paying more or less the right amount. There might be cheap stuff out there too, but I won't get it because I'm not the smart money that can actually look for it. And then once my money is invested, I will be taken advantage of left and right because there's nobody protecting me. In principle, I personally could sue, but of course I will never do that. I don't have the time. I don't have the expertise. I don't do that. I just want to save for retirement. World number two, indirect investor protection only, meaning let's remove the direct investor protection. That's a little bit of a harder counterfactual because the world we have has these mechanisms of direct investor protection. But let's try to imagine that we were to change the public stock market, investing in the public stock market in the following way. The dumb money, me, public investment funds, and so on, are not allowed to access corporate disclosures. They are not allowed to select when and what to buy and sell. Let's say they are forced investors in the index and they can't get out. They're not allowed to sue, and they're not allowed to vote. Or at least they can't initiate votes. Now, how would you feel in that world? I'll tell you my answer. I would feel pretty good because that's basically for practical purposes already the world that I live in. I mean, the world that I invest in, I should say, because that's exactly how I invest my money. I never access corporate disclosures. Maybe my fund managers do, but they don't do anything with that information. Me and they never select when and what to buy and sell. We just follow the index. Me and they never sue. And I never vote. They vote, but I don't think they spend a lot of time actually researching who to vote for. And still, it works because we have the indirect investor protection mechanisms. Now, as I said before, this is not because somehow the world is magically a good place. It is true that these indirect investor protection mechanisms, they sort of happen. I don't think any of them were planned to operate the way that they operate today, but there certainly are legal rules in place that ensure that they work the way that they do. And if we didn't have those legal rules, things would work quite differently. What are those legal underpinnings? For market prices, we force information through disclosure requirements, and we prevent manipulation. And what this does mostly is to foster competition between speculators. The reason why we think that markets are even somewhat efficient that the prices are approximately unbiased and informative, is not because we think that speculators are like omniscient or because we think that they're nice or anything of that sort, but because we think that they're in competition with one another. And they can be in strong competition only because there's a lot of information out there that they can all access, and because manipulation is generally prohibited. For other indirect investor protection mechanisms, we need primarily incentive alignment, meaning no side payments where the actor of indirect investor protection can get a payment while the shareholders at large do not. I have two examples here on the slide, two US corporate types. These are self-explanatory, but I think in this context I should explain what they are. One is what we call green mail. What is green mail? Some activists or wannabe takeover buyer knocks on the corporation's door and talks to the board and says, hey, we're going to make life really hard for you, the board, because we'll say that we want to buy you out or mount some campaign to change something that you do, unless you buy us off. So you take some of the company money, give it to us, only us, and then we go away. It's like extortion. From the activist point of view or the takeover buyer's point of view, that's just as good as doing activism the way we know it today, because they get money. But from a social perspective, it's way worse, because the activist just gets money, and that money actually is money that the other investors then don't get. There's less money in the company after the green mail has been paid. Compare that to activism, where the activist gets a financial payoff because they have improved the company. The way they make money is they buy low, improve the company, sell high. There, all the investors benefit. There's incentive alignment between the activist and the other investors. Collusive settlement, same idea for plaintiff attorneys. The plaintiff attorney could go to the defendant, let's say Elon Musk, and say, hey, Elon, how about you pay me some amount of money and I just drop the lawsuit? That would not benefit the investors in any way. In fact, if the settlement precludes later suits, it might hurt the other investors, but the plaintiff lawyer would do just fine. We don't allow that. There are rules, of course, prohibiting this, and that is necessary to align the incentives of the plaintiff attorney with the investors. We also have inducement, which can be explicit, as for the plaintiff attorney who gets a fee award. There's a rule for that in the United States. It's called the common fund rule. Or they can be implicit, as when the activist reaps trading profits that I just discussed. Why can the activist reap these trading profits? Because they don't need to disclose their trades immediately. If the activist hedge fund had to disclose their trades as soon as they make them, the price would jump up as soon as they want to buy. Maybe even if they have to announce in advance, it would be up already when they come to buy. And then they wouldn't be making any money from their trades. So we have to give them a bit of leeway. There, of course, are obstacles to indirect investor protection. I'll drop these in the interest of time. Another extremely important legal measure to activate indirect investor protection, we need to channel the dumb money into markets where indirect investor protection is active. This is why we have restrictions on retail investments in private markets, and we have restrictions on mutual fund investments in illiquid assets, which are assets for which indirect investor protection. I was confusing myself with that last point, so I will drop this for a second. I know what I wanted to say, but in the interest of time, let me focus on the first bullet point. Why are investors not allowed, private investors like me, not allowed to invest in private markets? If you thought that direct investor protection does the job, almost all of it is operative in private markets as well. I mean, I think I can certainly sue and I can vote. The only thing that I don't get in private markets really is the disclosure. But I could negotiate, for example, with a private company to give me disclosures, and I still wouldn't be allowed to invest in it. That's not the right way of putting it. I personally would be allowed, but the private company wouldn't be allowed to let me invest in them. But from practical point of view, it comes down to the same. We channel retail investment, or generally dumb investment, into public markets because that's where the full force of indirect investor protection is active. All right. Mandatory rules, the last point. Don't worry, Daniele. I come to an end here. what's the payoff of thinking in terms of indirect investor protection? For me, actually, the biggest payoff intellectually, maybe not practically, but certainly intellectually, is to solve a puzzle that has bothered me for a very, very long time, which is, why do we have mandatory rules in financial law at all? Especially, maybe it's too broad financial law, but certainly in the area of investor protection and public markets that I mentioned. Why is this a puzzle? If you think from the perspective of direct investor protection, it is paradoxical to have mandatory rules. If investors can choose the businesses, the capital structure, and so on of what they invest in, why can't they choose the rules? So you can choose to invest in a really dumb product with a really dumb capital structure, idiotic managers. You're allowed to do that, but you're not allowed to, I don't know, choose a dual class share structure in many markets in the world. Why not? If you're able to assess the business side, surely you can assess the rule side. That's paradoxical. In the framework of indirect investor protection, this is not a paradox at all. It's very easy to explain. There's a division of labor. There's sort of partial contractarianism. The smart money can choose or price the businesses for the dumb money. They're good at that. That's why we don't need mandatory rules to select what kind of businesses are allowed to get financing from the markets. But the smart money definitely won't choose rules protecting dumb money from smart money. So if we allowed completely free choice of the rules, we would get rules that will favor the smart money at the expense of the dumb money. And SPACs in the United States, I think, were one example of such a structure, which is now a thing of the past, but that was one of those things. So we need some mandatory rules because we need the rules to protect the dumb money against the smart money. Once that's done, we can then leave the smart money to make the business decision, which businesses get the money and what sort of capital structure is most efficient. All right. And maybe I should skip the passive threat for IIP and just summarize key mechanisms protecting public investors, in my view, are indirect. They do not rely on actions by the investors or by any private actor charged with looking after investors' interests. Rather, they are provided by the ecosystem that investors inhabit as a byproduct of the self-interested, mutually and legally constrained behavior of third parties without a mandate to help the investors, such as speculators, activists, and plaintiff lawyers, which I think elucidates key rules and resolves the mandatory versus enabling tension. And I will leave you with this thought experiment on the slide, which I find for myself the most convincing argument I could possibly make. And I'm looking forward to Daniele's and everybody else's comments and questions. Thank you.
Thank you very much. This was a fascinating presentation on what is really thought-provoking paper and thought-provoking research, but I think very much anchored in the reality of what goes on in the world of fund management. Daniele D'Alvia is a lecturer in banking and finance at the Center for Commercial Studies, where he works with me and other colleagues at Queen Mary University of London. And he has already, though he's a relatively young scholar, he has already published extensively. And one of his books, which came published in December 2023, is The Speculator of Financial Markets, which is very much in line with some of the ideas that have been presented already. So he will briefly discuss the paper as well as adding a couple of things from his own research. It's also his expertise. His first expertise was on SPACs, and so the special purpose acquisition companies, to which Holger just referred at the end of his presentation as one example that, is obviously a fundamental one and one in which Daniel is also an expert. So without further ado, and thanking Daniel very much for both continuing to do research in this area, but also having in the first place invited Professor Hallman to be with us today, which is really a wonderful way of starting our discussions in the London Financial Regulation Seminar. The floor is all yours. Following the presentation, Daniel himself will be handling the Q&A. We already have a couple of questions in the chat. And when you do the Q&A, or when you do the questions, You can either raise your hand or write the questions in the chat. So I will mute myself, Daniel, and give the floor to you. And thank you very much for having introduced also Professor Holger Spamann to the seminar today.
Thank you very much. Thanks, Rosa, and thanks, Professor Spamann, for this wonderful presentation that I think was very interesting. And I think, I mean, if I got correctly also your idea, there are some points that are key. And those points, I mean, in a way is that the indirect investor protection as a theory can be seen as a common value. And so a value that in reality is making human beings to progress. And it's something that then, when I read also your paper, that was the paper, in fact, about SPACs, and the fact that SPACs are, in your view, at least if I understood correctly, are the only instruments where the indirect investor protection is this. There is this application essentially of this theory because they are obliging the investor to do something in some way. And so this, in fact, I mean, it's a very interesting, I mean, vision, because then if I thought about even the SPAC, it's true that there is, at the end of the day, an investor that has to decide to redeem the shares. So that is something that in reality is not benefiting from the indirect investor protection, because if then, for example, the investor there is not active, he will have a detriment for himself. And in fact, I mean, SPACs, they show this. And in fact, also you said that for this reason, SPACs, and in this I agree with your theory in some way, because you say the SPACs then are an instrument that are antisocial, and maybe antisocial for this reason, because I think you want to say that indirect investor protection is a common good. And maybe SPACs are the one that they go against common good and they go against common wisdom in some way. So they are giving another view probably into this theory. And that was, I mean, something that I think is important to highlight also. Then, I mean, you said also about, or ask more information about the UK. And I think in the UK, if you think about even the role of speculators, I think that is something that in the UK, I mean, the vision of a speculator was always quite negative. And this is something that in reality, I mean, as you said, even once you speak about fair price, this fair price, you don't have a fair price because the speculator is doing a job for someone else. They're quite, in reality, I mean, individuals that are always been seen as the villain of financial markets or markets in general, because even in the UK especially, I mean, the first market maybe was the market of food. And so in this market, there was speculation of food. And this speculation of food was the first time in England where also there were passed specific laws to avoid speculation on food. And then in time, I mean, even in history, we had the South Sea bubble. And there in the 17th century, I mean, in the UK was a big phenomenon. And still we have another piece of legislation, essentially, that is going to prohibit even the incorporation of joint stock companies. So I think that there is a progression where regulation is a cultural phenomenon, but also attached to something that is always related to the past, and so to a financial history that is progressed. I think so for this reason, yes, the role of a speculator within UK financial markets is true that maybe is minimal, or in general, I mean, there are many mechanisms to reduce that that same trend that I can see very well what you mean in the US. So in the US, I mean, there is also different, I think, appetite for risk. And so something that in reality, Europeans or European markets, they tend to be risk averse in some way also, especially in the eyes of speculators. And the same thing is, as you said, the plaintiff lawyer. For example, yes, this role in the UK, we don't find. So this I think is very interesting. I mean, now that I got completely the theory through your wonderful presentation, I think would be very interesting, yes, to have or to work or to think about the paper to understand how in the UK those same things, maybe it's possible in the UK there are also other things that they might work and not maybe the same. And so that is, yes, something that I think is a key. Probably just to finish, I mean, the key information, the key, I mean, point could be also the fact that the prices, they are formed by information. And in fact, in that, maybe I think there is a commonality in the sense that information, and especially for a speculator to get that information before others, is even something that is more important. And so information, I think, could be economically and also for a perspective of setting prices in the market, something that will be in common between the two. But how this price then can be fair, probably the mechanism is different between UK and the US. So thank you very much. And I think we still got some time, and I wanted to give the floor a bit to the audience. And I see that here, in fact, there was already a question that is Chris Eaglen that said a friend invested in a number of US organizations when they were at universities, and then last year wanted to determine what had been yielded from the shares, only to find in most of the cases the initial shares had been changed due to takeovers, and the original shares were valueless, so they lost value. More than, I think, a question, this was a sort of statement, but of course, Chris, if you want to even, I mean, open your mic, we are happy. Other questions? I don't see still in the, yes, there is one about the recording. Yes, this event will be recorded, so subsequently, after the approval of Professor Spamann, it will be published online, yes. Any question from the audience?
Maybe while people are warming up to their question, Daniele, may I perhaps say something about in response to your very kind comments?
Yes, absolutely.
Yeah, so one thought triggered, just one clarification, you know, when you mentioned speculators and you mentioned food speculation. And I think there is I think, at least possibly a critical difference between food markets and financial markets, which is that in financial markets, the developed financial markets like the UK, or I shouldn't say financial markets, but developed securities markets, like the stock market in the UK or in the United States, you have two things that are often not present in food markets. First, you have short selling. So you don't only have upwards pressure, you also have downwards pressure, which is critical in order to get the price right. You know, otherwise you would get it systematically too high. Secondly, you have competition. You have a lot of competition to get the price right. Whereas in food markets, what often happens, and I think not the only, but a major force why people have a negative reaction to speculation in food markets, that food markets can get cornered. And somebody might be able to amass a large fraction of the market and then raise prices artificially. And we don't have that really in financial markets, at least not in the big ones. It does happen. I mean, in fact, we have rules also against that. It's part of the anti-manipulation rules that I mentioned. You're not allowed to corner the market for a stock. And to the extent that those rules don't work, then of course we would have a problem also in the financial markets. But I think it's a bigger issue in food markets simply because there's not one centralized market that is as liquid as the stock market is.
Yes, I mean, I disagree. Yes, this was just a clarification that, I mean, speculation can take many forms. And so essentially, I mean, yes, was even historically, even in the food market. But also, I think in my book, I said also that there was a time in the US before the Securities Act and before that time in 1933, before that there was a very famous speculator on New York Stock Exchange that he was doing this cornering the market. So in reality, that was a practice that was common, but then actually, yes, they started to be regulated, forbidden, and sometimes, I mean, even today, they still sometimes forbid short selling for a short period of time. Like once there was in Italy, for example, Monte dei Paschi di Siena, that was going probably to collapse. There was a big short selling of investors, and the Italian government just passed a law that at least for, I don't know, 1 year, 6 months, you could not short sell the shares of Monte dei Paschi di Siena. So yes, there are always, I mean, negative points of the speculators, but I agree on your point that essentially the speculator is a figure that without the speculator, we might not have this dynamic of markets and how the ecosystem also works. Yes, in this for sure. Then I don't know, the fair price, I don't know, maybe this is my question. Like, have you ever thought about Keynes is like idea of how prices in reality, that financial markets are like a beauty context. So in reality, all the investors, they second guess the opinion of other investors, and the final value is not the value that is fair in reality, but is a subjective opinion that might. And so, yes, this was maybe my question. Why the adjective fair if we think about Keynes, that he thinks that is not fair, basically. He thinks that is the price of today that might be undervalued or overvalued, essentially. So
Yes.
yeah, this was my question, like why you call it or define it as fair price. Yes.
Yeah. So I think there's really two aspects to what people often discuss under the heading of market efficiency. One is market efficiency, strictly speaking, the price corresponds to some fundamental value, whatever that may be, is an almost religious concept. And the other one is that you can't systematically beat the market. For my purposes, I really need both a little bit, but I need the second one much more. Because if you were to systematically lose, if you don't select your investments well, that would bode really badly for people like me who are saving for retirement. It would make it look like a really bad idea to have people channel their money into financial markets for saving for retirement. And then on that note, we have pretty good evidence that markets actually have that quality. Liquid stock markets have that quality. The first one, fundamental value, is harder. There's like decades of debate over the question of market efficiency. And my summary of it would be something like the following. Nobody thinks that markets are completely efficient. This is by now, I think it's dead. Nobody believes this. But most people, or the vast majority of people, even critics of market efficiency like Bob Shiller, think that at the level of individual stocks, like one stock relative to other stocks, the market is doing a pretty good job at pricing things, which is all that I really need, because what that gives me is that if the market prices, in particular governance arrangements, good ones, bad ones, then the market will reward good governance arrangement and punish bad ones. And it does that without people like me or my index fund manager ever really looking at these questions. There's a harder question. That's really the one that you raise, and where Bob Shiller would have a view very much like Keynes. The market overall is driven probably by a lot of sentiment, I guess is what people usually say. And at that level, that's not an irrelevant concept for investor protection at large. And I think you might say that if you believe that the more you believe that the market is driven by sentiment, irrational exuberance, I think was Schiller's, the name Schiller gave to it in his book, the less you should think that it's bad to entrust basically society's savings to the market and to have our activities guided by the market. But that's a question really of how do you want to organize your pension system? Do you want to channel your pension system through financial markets or not? How financialized do you want society to be? At the level of individual investor protection, once we have this market, how do we make sure that, given that I have my money in the financial markets, how do I make sure that I don't get screwed?
Yeah.
It's too late. That ship has sailed. Now we're only talking, am I going to get more screwed than the smart money or not? And that's where I come in, and where I say, you don't actually need to give me direct protection. It's enough if you make sure that the indirect protection is present.
Yes, now it's clear. Yes, it's very fascinating theory, I need to say, especially because it's based on this role of the ecosystem that is something that I took in other ideas in general. I don't know if there is any question from the audience. or maybe from students. I don't know. I see Domenico or Marcello. Do you have any question? I think we scared them. I don't know. No, yes, there is. So Marcello is asking, could the lesser development of plaintiff lawyers in Europe and Asia be a limiting factor for the growth of financial markets in those regions, given the importance of plaintiff lawyers in indirect investor protection?
I mean, yes, if you ask me, absolutely. But to me, I would ask the question a little bit differently. The puzzle, it's really a question, and a question that you might have some insight in coming from the UK. How does the system, I don't want to say the legal system, because perhaps it's broader than that. Perhaps there's media involved and tax enforcement and reputation and social sanctions. How does the system protect outside investors against self-dealing by the insiders, managers and controlling stockholders? Now, we all know anecdotes of where this system fails. The most entertaining, shocking, whatever you want to call it, anecdotes come from places like Russia in the 1990s, where the controlling stockholders literally stole everything. But it's a problem everywhere, and it happens everywhere to some extent. And in the United States, the biggest mechanism stopping it is the plaintiff attorneys. So if other systems don't have the plaintiff attorney, the question is, how do they do it? Some systems bring to bear the machinery of mandatory audits and criminal enforcement. So like a really bad fraud, in most European jurisdictions, you would have to commit audit fraud, accounting fraud. That's criminal. And, a lot of fraudulent accounting is not detected. But when it is, of course, you can get the machinery of criminal law come down on you. And maybe that is the outer limit. I don't think it's as effective as the plaintiff lawyers, because a lot of what's going on is that some transactions, you don't have to commit accounting fraud. You just dress them up in a way that they look like legitimate business activities, but it turns out that they tunnel out a lot of the value of the firm. And at that point, it's not, you don't have to, there's no fraud in the criminal sense, but it's still a very asymmetric and unfair transaction. Right, unfair, It doesn't share, it does not distribute the value in the company in proportion to the shares that people own. So how do you protect against that? And if a system isn't good at doing that, that I think limits the size of the financial market very much. But since we're on it, let me add another puzzle to me. And that's also in a footnote on the paper, which is China. Like China has had an amazing growth of the financial market. At this moment, who knows? Maybe they're at the brink, maybe their market will crash, who knows? But at least until now, they've had an amazing development. The financial market has become very large. A lot of money channeled through the Chinese public stock market. But by all accounts, they have nothing like the investor protection system that we have in the United States. They definitely don't have plaintiff lawyers. Yes, they have some they have some speculators, but they don't really have activist shareholders, activist hedge funds. They don't have plaintiff lawyers. They have some takeovers, but not really hostile. So how do they do it? What's holding that system together? And there's two answers here, two possible answers. And I don't know which one is the right one. One possible answer is that they found a way to do this through soft and hard government pressure. So I've occasionally talked to Chinese lawyers, and the way they tell me that their practice is just very different from how it works in the United States. One lawyer told me that when they want to do something, they call up the regulator and ask them if this is okay. And I mean some transaction. That is not how American lawyers operate. I mean, yes, if they are really, really worried and they want to basically negotiate with the regulator, they might do it. But usually they just do it because they think they know what's legal and they push the boundary and they just do it. That's not how the Chinese operated, because my understanding is that the Chinese regulators, they have ways to exercise pressure, a lot of pressure if they don't like what you're doing. And so maybe they hold it together. That's one option. And, good for them if it works that way. I would be worried, but, good for them if it works that way. The other option is that the Chinese market has been in a gigantic bubble. in a gigantic bubble because everybody was just pouring their money into that market, believing that the market can only go up and it was a new thing and, you know, it's fun and whatever. And the bill will come due very soon when they will figure out that when the going gets tough, controlling stockholders tunnel out the money and leave the company as an empty shell. You know, we'll see if that happens in China. But yes, I think in my world, in the United States, I'm pretty sure that without plaintiff lawyers, the system would not work. But that's sort of my question. Like, how general is my theory? And if it's not general, then my question is I'm not arguing. I'm just really asking. You know, what else is it? What takes the place elsewhere?
Absolutely. Also, because I think you have always a comparative law interest, and this is something that especially is in growing demand, essentially, even in the US, from what I saw from other colleagues. Comparative financial law is becoming more exponential in the US to understand also, especially how other systems they work. And the same, I think, is in the UK, essentially. After Brexit, the comparative law has become much more important than before. Yes.
Do you have one more minute to say something? Because actually,
yes,
I'm happy to answer more questions, but
yes,
if
yeah, exactly. I mean, I wanted just to ask if there is another question, because yes, we have just 2 minutes essentially.
Yep.
Otherwise, we can call the day. Any question? No.
If there's no, Daniele, let me say one more thing that
Yes,
I
absolutely.
skipped in the interest of time, but you emphasize it's the ecosystem view. I should have said during the talk, and I'll say it now, that one thing that's very important is that these different actors that I mentioned, they interact. So the reason why we don't have green mail today in the United States, the reason why the activist hedge funds don't just collect basically extortion money from companies, is because if they tried that, some plaintiff attorney would come along and would get that payment rescinded. So there's the active, in other words, the activist, the shareholder hedge fund activism is good, is a force for good only because it's kept in check by the plaintiff attorneys. And in turn, the activist hedge funds only work because market prices are more or less correct. If the market prices didn't reflect the good or the bad that activist hedge funds do at the companies, then we could not trust that the activist hedge funds are actually doing positive things for companies, because they might be rewarded for doing bad things or penalized for doing good things. So that things they all interact, which is why I like to call it an ecosystem.
Absolutely. I agree completely on that. In fact, I was happy to highlight that, and I'm very happy that you clarified to everyone this concept. So without further delay, I think we can call the day. And I thank you a lot to be here and to have explained to us and to our students and every participant your theories. Thank you very much, and I hope we will meet soon in the future.
Yes, in person. Great.
Thank you.
Thank you.
Thank you very
Bye-bye.
much. Bye-bye.